So you've talked in the past, Dan, about what you call a Thucydides trap, sort of trying to at least give people a sense as to the emerging power in China and the U.S. Are things following along the lines you perhaps anticipated when you first started talking about this?
Well, I think, to be frank, they're going a little bit faster and not quite the way. I mean, this is impossible to judge, but the pressure is growing faster. I think nobody would have thought a while back that our reaction would be exactly what it is and the implications of that. And the pressure that China is putting on Taiwan right now via Hong Kong is, it's been coming quicker. It's been coming quicker. And the trying to find things where we mutually agree so that we can push the trap aside and deal with the climate thing has been tough. So, and that's discouraging, but understandable.
All right, so what does that lead you as a manager of a large bond portfolio to do in terms of the way that you're allocating capital right now?
Well, you have to be more conservative than normal. We still, the basics are item selection, et cetera. But you do need a liquidity reserve, and you need flexibility. You have to, if this is solved, let me be very positive for 1 minute here. If this is solved, there's an enormous investment opportunity spread across Asia. So you can look to this, you can be hopeful. Now, if it's not solved, then that opportunity isn't there, and there are some other things that aren't so good. So you have to stay on top of it and have the flexibility, have the liquidity to find the opportunities if they start to emerge. In the meantime, you deal with what you have in your hands right now, which is the Fed and the markets and the volatility inside some of the markets, and the economic impact on the corporate earnings, that sort of thing. So it is business as usual, but the might say the environment that we're running money in is different than previous times and requires more flexibility.
So where do you think the 10-year is going to end the year?
Where do I think what's going to end the year?
The 10-year yield will end the year. How low does it go?
Oh, the 10-year. Oh, let's see. Right now you're around 175, 170. My guess is it's going to be more like 150, possibly lower. Let's face it, the Fed is trapped by the current environment. They really can't. I know there's a division of opinion here, and if the U.S. or North America were the only part that we were concerned with, then the Fed probably would not be reducing rates. And for anything, they might be slightly increasing them, or at least on hold until they see how big an economic impact we have from the trade wars. But we do have the trade wars. We do have the world outside of us. And not only our own central bank is trapped by this, but other major central banks, the money center central banks, are trapped. The about to be money center currency central banks are also trapped. That includes China. So it's the political environment that's dictating which way the government yield curves go, not only in the U.S., but in other major markets around the world.
Well, you mentioned other major markets, Dan. $15 trillion in debt has a negative yield, sovereign debt. I've never seen anything like that, of course. How do you even get out? How do you get an economy, and how do you sort of get out of negative interest rates once you're sort of there?
Well, that's if I could give you an answer to that, we could both make a ton of money. I don't know. The situation that the European Central Bank has on its hand is just hard to resolve, and we have to remember they're also caught on a worldwide situation, not as directly as the U.S. is. But they do have a lot of the changes in the world. The climatologists talk about this, that, and the other thing. Well, the people are moving away from the areas where the climate change has destroyed the crops. You can't hang around a place where you can't eat. And that's having a heavy impact on Europe, to say nothing of other parts of Africa. So then you have a very orderly, well, not as orderly as it was a few years ago, but you have a very orderly political situation within Europe, within the Euro structure, but with also a lot of tension between the individual parts of the government. But nobody's shooting. Nobody's shooting at each other. And the low rate, or I might say the ample liquidity environment, has definitely been a help in that. Now, where do you go from here? I mean, who wants to put their money in a bank or a bond where you have to pay to have it there? What are you going to do? Pile up euro bills in the basement? Eventually what you do is you go towards other assets. And so the threat they have is the loss of the integrity of the monetary unit, and that's the risk they're taking.